Ever wondered how cash buyers actually pay for houses in Chattanooga, Tennessee? Maybe you've seen those "We Buy Houses for Cash" signs plastered on telephone poles, those late night Facebook ads popping up while you're scrolling, or a stack of "We Will Buy Your House Fast for Cash" postcards collecting dust somewhere in your house. But are these folks really showing up with a suitcase full of cash like some Hollywood heist movie? Spoiler alert, it's not that dramatic. However, what actually goes into a cash offer is a question many homeowners still have. I'm Molly with Cash Out of My Home, and we've been buying and selling houses across Tennessee and the Southeast for the past 8 years now. And today, I'm pulling back the curtain on how cash buyers actually work, where the money comes from, and what it all means if you're looking to sell your house fast in Tennessee. Whether you're facing foreclosure, dealing with a fixer-upper, or just curious about what a local cash buyer in Chattanooga could offer for your property, this video has got the full scoop. So let's dive right in. All right, let's break it down. Who are these cash buyers scooping up houses all over Tennessee? They're not your typical home shoppers looking for a white picket fence and a cozy front porch nestled in Chattanooga's green scenery. No, these buyers are professionals and they make their living on buying and selling real estate, and they usually fall into 4 categories. The first category is you've got your solo or your small investor. Think mom and pop. They're local players with a good understanding of Chattanooga's specific market and a sharp eye for undervalued properties. They know how to help you with a variety of situations and often have local connections that can help you reconcile messy title issues if necessary. Then you have your big funds that are snagging up large parcels of land and they're looking to develop neighborhoods from the ground up, or they're looking for commercial land so they can develop apartments or maybe warehouses for these large tech companies coming into town. Then you have your We Buy Houses franchise companies, the ones that you may hear on the radio ads or you're going to see them on the billboard. And these people will operate in several different states because they don't have one physical location. And their bigger competitor, which are a bit newer to the market, are the iBuyer or OpenPad or Open Door type of companies that are more reflective of technology, that are using algorithms and AI for their business model. Well, we've worked with all of these companies over the years, and here's what sets them apart from your traditional home buyer. They don't deal with banks in the traditional sense. There's no 30-year mortgage. There is no financing contingencies like appraisals or funding hurdles to cross. And they're usually working with straight up cash, or at least something that works like cash, like a hard money loan or private money. And that will often mean that there's no delays, no appraisals, and no funding falling through at the last minute. And most of the time, no red tape slowing things down. I've seen cash buyers take on everything from hoarder houses that would scare most people off to nearly move-in ready homes that just need a little bit of TLC. And the price that they'll pay completely depends on several factors, which we are going to break down in a bit. But if you're looking for a buyer who will purchase your house completely as is, with no hassle, no drawn out contingencies, negotiations, or inspections, and you are really looking for that fast closing, then a real cash buyer in Tennessee can make it work for you. So where does the money actually come from? So where do these cash buyers in Tennessee get the funds to snap up these properties? Contrary to popular belief, they're not all sitting on vaults of gold like Scrooge McDuck. The reality is a bit more strategic, and it generally falls into 3 main funding sources. So number 1 is a solo investor and a personal capital. So solo investors aren't as common as other types of cash buyers, but when they are active in the market, they tend to be pretty well known, and they're experienced and most of the time reliable. They may not be the biggest buyers in town, but their advantage is stability and a long-term presence. Every profitable deal that they close adds to their individual portfolio, which allows them to reinvest into new properties and keeps their business going. One key thing to understand about solo investors is that they often refinance properties to pull their money back out after the purchase. You may have heard it. This strategy is called the BRRRR strategy. buy, rehab, rent, refinance, and repeat, which allows them to continue buying houses with cash instead of it being tied up into the house or into a bank. And unlike hedge funds that might be here today and potentially no longer buying in that market tomorrow, these are going to be your local players, the people who have been buying and selling and renting houses in the city for years, which will also make them the most reliable type of buyer to sell or finance your house with if you are considering going down that route. And a good way to tell if a buyer is truly local is by looking at which closing company they use. So if they're working with a title company that's in your immediate county or city, chances are that they have done multiple transactions there before. And in fact, you can even call the title company to verify their legitimacy. We've had sellers do this before, and once they realize that we're real people who have successfully closed deals, their concerns are usually put to rest. So most local investors will meet you at the property themselves, and after just one or two walkthroughs, they can provide a straightforward offer because they know what they're looking for, the market that they're in, and most of the time they know the exit strategy that they're going to have for that property. Many of these investors own rental properties in the area, and they're the ones that are behind the latest flips in your neighborhood or maybe the newest home builds in your neighborhood. They might not be using their own capital all of the times. They may be using private money from a trusted partner or even hard money from local banks that they've built relationships with over time. The number two funding source would be hard money and private money. So cash that isn't really cash. Hard money and private money aren't the same as pulling cash out of a bank account, but they operate like cash when they're buying a home. These types of funding are structured as short-term loans given to the real estate investors by private lenders, not big banks. So the major difference here is traditional banks look at the borrower's finances, while hard money lenders only care about the deal itself. So how does hard money and private money actually work? Well, hard money and private money lenders are laser focused on the property and its investment potential rather than things like credit scores or debt to income ratios. And instead of looking at whether the home meets the appraisal standards for a traditional mortgage, these lenders focus on these main things. Number one, purchase price. Is the investor buying it at a price where they are guaranteed to make a profit and pay that lender back? Number two, rehab costs. How much work does the house actually need? Will the property make a profit even with the considered renovation budget? What if they happen to exceed that budget? Number three, after repair value, ARV. What will the home be worth once it's fixed up? These types of lenders are often less optimistic than the investor themselves when it comes to the resale value, which is only to protect their interest. Number four, assessing stability and risk. They ask themselves, how likely is it that the investor will finish the project and sell it or rent it immediately and successfully? Because hard money lenders aren't relying on long approval processes, appraisals, or underwriting delays, they can fund deals pretty much as fast as 7 to 10 days. And since hard money and private money loans don't operate like a bank and they operate like cash, sellers still will get the same benefits like a quick sale, no bank contingencies, and a smoother closing process like an all cash offer. Number three, funding source, investment partnerships and large scale buyers. Think hedge funds and institutional investors. Big investment firms, hedge funds, and national We Buy Houses franchises are a whole different category than the cash buyers we were just speaking about. Unlike solo investors or house flippers, these groups aren't just looking for a quick flip, they are actually playing the long game. And many of these buyers pool investor funds from all over the country or potentially even globally and strategically acquire properties in markets where rental demand is strong or is foreseeably going to be strong. What's their goal? To build a large-scale portfolio of rental homes that generate steady cash flow over time. Cities like Chattanooga or Knoxville or Murfreesboro are attractive to them because they often relatively have affordable homes, strong job markets, and consistent rental demand. These institutional buyers often buy in bulk and will follow strict acquisition criteria, things like requiring properties to be at least 3 beds, 2 baths, avoiding homes that are on septic, septic or homes that are on flood zones, and they typically will stay away from older homes or homes that need major repairs. They will rely heavily on data and algorithms to determine their offers, which can sometimes lead them to offer higher than expected initial offers compared to your local investor. However, these deals aren't always guaranteed to close since their approval process can involve multiple layers of decision making. Since they're holding properties long-term, they're less concerned with immediate resale value and more focused on stable, predictable rental income. This means that they may be willing to pay slightly more than a house flipper, especially if the house is pretty much ready to go and does not need any major repairs. Then they're most likely willing to work with you. And usually they will pass on a property if it doesn't fit their buy box without negotiation. So how does this affect the cash offer that you'll receive on your property? Well, if you're selling to a cash buyer who's buying your house, matters more than just is what they're offering. The type of investor on the other side of the deal is going to directly impact how they structure their offer and what they're willing to pay, and most likely how smoothly the transaction will go. Here's an inside look at how different real estate investors approach buying houses and what that means for you as a seller. So what does a rental investor think about before making an offer on your house? When an investor is buying your house as a rental, their decision making is less about flipping a house for a quick profit and more about that long-term cash flow. They're looking at whether the property will generate stable rental income after factoring in their holding costs and any repairs if necessary. When a buy and hold investor looks at your property, they're not just thinking about the purchase price, they're calculating how soon they can start generating that cash flow and what kind of risks that they're taking on. If they're financing the purchase, they have to cover the mortgage payments, property taxes, insurance, and any maintenance costs until the rent actually starts flowing in. The existing tenant situation does play a huge role. So if the property is already rented, they may need to raise the rent right away to cover expenses, or if the tenant is paying below market value or is unwilling to leave, they have to factor in cost and time for a possible eviction. Vacancy risk is another big consideration if the house has a history of sitting empty for long stretches or is in an area where rentals don't actually rent quickly. On the flip side, if the home is in good condition, needs a little to no repairs, and can immediately start cash flowing a few $100s a month, then this investor may be more willing to pay more for your property since they won't have as much extra money in renovations and deal with problem tenants in the future. If your house is turnkey and has stable tenants paying fair market rent currently, a buy and hold investor might be willing to offer just a bit more since they can start to see a return right away. And many of these investors also love seller financing, where instead of paying cash up front, they make monthly payments over time to you. This can actually work in your favor as the seller. You could end up making more on your property in the long run with steady, predictable income instead of a whole lump sum of cash. But if your property has complicated tenant situation, rents are far below market value, or it needs a significant amount of updates and repairs before it can actually cash flow, do expect the investor to price in those challenges into their offer. At the end of the day, long-term investors are looking for properties that make financial sense. If they see an easy path to strong rental income, then they'll pay competitively. But if they see risks, whether it's costly repairs, tenant issues, or a slow rental market, they are going to adjust their offer accordingly to protect their bottom line, of course. The second type of buyer is your fix and flip investors, the short-term profit seekers. How do they buy properties? Flippers operate on a completely different financial model than rental investors. Their goal is simple: buy low, renovate fast, and sell for profit. But to make their numbers work, they have to be extremely careful with their purchase price. So here's what flippers consider before they make an offer on your house. Number one is hard money loan costs. Most flippers don't use their own cash, they use hard money loans, which can carry high interest rates, often up to 10 to 15%, and it must be repaid within months. The longer the project takes, the more expensive that loan gets. Number 2, rehab budget and unexpected repairs. Every flip comes with surprises, whether that's hidden mold, foundation issues, outdated electric, whatever. A flipper will price in a safety margin to make sure they don't go underwater on the deal. Number 3, realtor costs and fees. When they resell the house, they're going to pay that 6% or more in agent commissions plus closing costs, which adds to their bottom line. And they also pay closing costs when they buy your house. Number 4, market timing risks. A flipper must sell for profit at all times. If the market shifts and mortgage rates spike, or the demand softens in that market, they could potentially get stuck with the house that's not gonna sell. And because of this, they tend to offer a little bit less than other investors so they can keep their risk low. So how does this affect your offer? Flippers often offer less to protect their overall margins. And since they have to account for renovation costs, carrying costs, and resale risks, their offers are typically lower than a rental investor or even a hedge fund buyer. They need that resale safety margin. So if they think they can sell your house for $250,000, they may only be willing to pay you $150,000 to maybe $180,000, depending on repair costs. They need at least a minimum of 20 to 30% of a margin to make the deal actually work. But on the other side, they do have fast closings, although the price limits are tight. Flippers can move fast and they can close quickly on your property, but they're most likely not going to overpay just to make a deal work. If the numbers don't work for them, they'll probably walk away. Number 3 would be hedge fund buyers and institutional buyers. These are your market dominators. Hedge funds, large investment firms, and franchise-style we buy houses companies aren't in the business of quick flips or smart market deals. They're playing the big game and they're aiming for large-scale market control. With millions or even billions of investor capital, these buyers are typically here to purchase properties in bulk, focusing on acquiring as many rentals as possible in key markets that they think are gonna come up. If they're aggressively expanding into a city, they may be willing to even overpay in a short term just to secure more inventory. Their pricing isn't based on a gut feeling or a quick walkthrough. These companies rely on data-driven algorithms that analyze home prices, rental demand, appreciation potential, and broader market trends. This approach sometimes leads to surprisingly initial high offers, but it also means sudden shifts if the data changes and the market flags an issue, and they might lower their offer and potentially back out. Unlike smaller investors who evaluate deals on a case-by-case basis, hedge funds operate with a strict buying criteria. Many will only purchase certain types of home, often a 3-bedroom, 2-bath, properties in suburban areas, avoiding anything with a septic system, potentially anything in a flood zone, and they are trying to avoid properties that have age-related issues or homes that have complex repairs or complex title issues. If a home doesn't meet their requirements, they most likely are not going to negotiate. They're just going to move on to the next new opportunity. But the advantage of working with these buyers is that they often have access to much cheaper capital than individual investors or flippers, meaning that they can sometimes pay slightly more than a local cash buyer, which doesn't mean a guaranteed sale. If your house fits their criteria, you might get a strong initial offer, sometimes higher than what a local investor would pay. However, that offer isn't always set in stone. If their underwriting team finds a problem during due diligence, such as foundation issues or an outdated electrical system, they might adjust their price during escrow or potentially cancel the deal altogether. Additionally, hedge funds do tend to move a bit slower. So if you are looking to sell your property within the week, hedge funds are at least going to take 30 days up to 60 days because every deal has to go through multiple layers of corporate approval. If speed and certainty are your top priorities when it comes to selling your house, then they may not be the best fit for you. But if you're flexible and you like their offer, then you could walk away with a higher selling price if you're willing to play their game. And there you have it, Tennessee homeowners. You have just cracked the code on how cash buyers pay for houses. If you're thinking about selling, the most important thing is understanding who your buyer is and what their strategy is, because that determines how they structure their deal and what they're going to pay for your house. A flipper is going to factor in those renovation costs. A rental investor is going to focus more on cash flow, and a hedge fund company might initially offer more, but only if your house fits their strict criteria. The key takeaway is not all cash buyers are the same, and the highest offer on paper isn't always the best deal if the cash buyer isn't truly committed to buying your house. So if you're considering selling your house for cash in Tennessee, take your time to vet your buyer. Ask how they're funding the deal, whether they've closed on similar properties, and who their title company is. A legitimate buyer will have no problem answering these questions for you. So if you found this video helpful, make sure to like and subscribe and drop any questions that you have below. We'd be happy to create another video answering it. And if you're looking to work with the real cash buying company in Chattanooga, whether that's land, mobile homes, a single family property, or multifamily, reach out to us. We've been buying homes in Chattanooga since 2017 and we'd love to help you. My name is Molly and I'll see you on the next video.